Yes. For this video, I am going to be breaking down the capitalistic order, the pyramid scheme, the hierarchy that there is in the trading and investing industry. We are all, everyone that's watching this video, we're all either aspiring traders or we are currently traders. And in order for us to receive any sort of success in this industry, in this game, we must know who we are dealing with and who the players are. So I'm going to be breaking down the structure that we have. I call it the capitalistic order, the hierarchy, the structure that there is in trading. Okay, so I'm gonna start from the top. So at the top, the very, very top, the peak of the mountain, the tippity top of the capitalistic order, we have the central banks. So these are the central banks of the currencies that are involved. So if you are someone that trades USD JPY, you will be focusing on the Federal Reserve and the Central Bank of Japan. Let's say you trade Euro USD, you'll be focusing on the it's the ECB, European Central Bank, European Central Bank, and then Federal Reserve as well. Federal Reserve is, that's again, you need to do some research on that. The Federal Reserve is the people that control the United States dollar. So yeah, that's the tippity top. These people, they set the interest rates, they do everything at the top, and it affects everyone below them. So yeah, below them, investment banks and hedge funds. These are people who hold lots of money and they group together and they create big companies, which is either an investment bank or a hedge fund, and they do trading on a big scale. Now, these players are usually in connection with the players that are in the central banks, and we will speak a little bit about that just in the near future. But yeah, I'm just going to move down the hierarchy and move down the pyramid. So yeah, an example of a hedge fund or an investment bank, JP Morgan, that's an investment bank. There's many big players. If you just do some research on Wall Street, you will find a lot of examples. Moving down, we got brokerage firms. These are the people who me and you have to actually place our trades with and have to connect with in order to make trades and make orders in the market. So these include the likes of CMC Markets, Pepperstone, Forex.com. There's many different brokerage firms out there as well, and they basically hold your money for you in a trading account. So it's like putting your money in a bank account, but it's a trading account, and then that money is your outstanding equity, and then you use that money you leverage that money and use that money to make trades through the brokerage firm. And then at the bottom, which is us, we've got retail traders. So these are people who are bringing their money into the markets, making orders, making trades, placing trades, all of this. So that is where we are in this pyramid scheme. So if we're here, and I put liquidity over here, I put liquidity because you need to do research, like actually watch videos and hear people who are up here, hear them talk about the game as a whole, and they will give you some insight as to like what is actually going on. Retail traders are just liquidity. We are liquidity for the brokerage firms, the investment banks, for them to be able to move their money and actually make these trades, because they also place trades as well in and out of the markets. Now, the reason why I said we are pretty much liquidity is because they use the retail trader mindset, behavior, patterns to benefit and profit. Now, people that actually don't know this, you know, when you are first getting into trading, you don't know this, you don't realize this, but it's the truth. First and foremost, I'm going to give you guys just the simplest breakdown. If we go one step above this pyramid scheme and this hierarchy, we have brokerage firms. Every single trade you place with the brokerage firm you are using, they get money because they earn money through commission. So they have a deal with the larger exchange, which is basically saying the more orders you give us, the more money we will give you. Because we need traffic, we need flow, we need players in and out of the markets. So just think about that. The average retail trader with the mindset of let me get rich quick, let me flip money, let me do X, Y, and Z. They are usually all high frequency traders, placing 10 to 20 trades per week and blowing accounts very, very quickly, and then recycling that money over again to put money back into a new account to then do the same thing. Every single trade you place with the brokerage firm or whatever broker you are using, they earn money through the commission. So just think about that, retail traders out there. The average retail trader is not supposed to win. This game is not for us to win. This game is not for us to succeed. So you have to be different. You have to have a different mindset, different level of awareness in order for you to actually succeed as a retail trader. Or you can just simply climb up this pyramid scheme and work with the big players and get yourself into them groups. There's ways about it. So yeah, brokerage firms, just think about that. Every trade you place, they earn money based on commission. So they want you to keep trading. They need you to keep placing trades. So that's one. Number two, that's one reason why we are liquidity. The second reason is the smart money up here in terms of the hedge funds, the investment banks. So when you see price action on the charts, this is not retail traders. This flow of movement is not retail traders. This is all smart money. This is all the investment banks, hedge funds, central banks. This is all of them, because there's trillions of dollars being moved in this market every single day. Trillions with a T. So us retail traders playing with small amounts of money, you might think $1 million in the markets. If you have £1 million in a trading account, that's a lot. It's nothing. It's nothing compared to what these people are using and what they have. They are moving trillions of dollars every single day. Your 1 million, 2 million, it doesn't move the market. So all of this movement that you see happening is all smart money. It's all hedge funds and investment banks moving money. And what they do is they trick the average retail trader to create liquidity to then be able to move that money. And I'm going to explain that to you guys right now. Let's say the large investment banks, hedge funds, institutions, whatever you want to call it, let's say they decided that when price gets up to this level, they want to start decreasing their position. They want to start getting out of Euro USD. So let's say they was in the market already and they want to start decreasing their position up here. They can't just pull their money out, because once they pull their money out... Alright guys, so temperature too hot on the phone, so I'm coming back with the second segment, but I've got a little diagram right here, as you guys can see. Hopefully you guys can see that clearly. So These big banks, institutions, hedge funds, who are carrying trillions and billions of dollars in volume, they can't just sell whenever they want to sell. If they are in profit and they want to get out at a certain price, they can't just liquidate all of their position, because they will end up losing big amounts of money. Now, the reason is because of something called slippage. Slippage is where, because these big players, the smart money, are the people that are actually moving the markets, they need people to take the other side of their trades. So if they sell here, they're not going to see profit. They're actually going to see losses, because they are the ones that are actually moving the markets. So when we talk about fill, like being able to get filled in at a certain price, if they wanted to sell at $4,507 an ounce, let's just say this is gold. If they wanted to sell at this price, they won't get filled in at this price. They will get filled in way down here, because they are the people that are moving the markets. And so they might actually see a loss, or a substantial amount of their position will be at a loss because of that. So what they do is they create liquidity, which is they make retail traders do what they want them to do, so then they can take the other side of the retail traders' positions and get filled in at the correct price where they need to get filled in at. So they will bid the market higher, push retail traders to buy, and then they will liquidate their position, and then you will see a huge drop in price. And all that is the market makers, the investment banks, the hedge funds, the institutions. They are liquidating their position. They're getting out of the markets. So then on the charts, you will see a huge candle just going all the way down. This is important, because in order for you to be a successful retail trader, you need to understand the players that are in the game and what their motives are. Market makers, do your research on market makers. I'm going to request a video for you guys. So this video that I'm putting up on screen is a video on YouTube. I highly recommend you watch this video. This is a market maker who is talking about the business as a whole and his involvement in it as well. So yeah, this video speaking about the capitalistic order, the hierarchy in the trading and investment industry, and knowing where you are in it, retail traders being the foundation, and knowing how you can actually succeed. So in order for you to succeed in this game, you cannot think like the average retail trader. You cannot behave like the average retail trader. You cannot trade like the average retail trader. You have to have a different mindset. And that mindset will reflect in your behavior for you to succeed in this game. So yeah, that's the end of the video. See you guys in the next one. This is the first video I'm going to recommend for you guys. This is a market maker who is talking about the business and talking about the insider information. So I highly recommend that you go watch this video.